Okay, so tonight's session, we're going to be covering change in ownership. What you need to know that there are different ways that there can be change in ownership, but basically a change in ownership transaction is triggered when your percentage shareholding changes. Okay. What is important to understand is the impact it would have on the income statement, the impact it would have on the statement of financial position, the impact it would have on the statement of changes in equity, and the impact it would have on the cash flow statement. We're not going to be dealing with the impact on the cash flow statement now. When we come to cash flow statements towards the end of the year or the end of the course, then we will cover those aspects. But in the remaining weeks up until test 3, we will deal with the impact on the income statement, the impact on the balance sheet, and the impact on the statement of changes in equity. Now, for CTA level 1, you have to deal with 4 types of changing ownerships. For CTA level 2, everything. Okay, there's different ways. You must know everything. Okay, so for CTA level 1, it is a normal investment to an so a normal investment, an IFRS 9 investment that becomes a subsidiary, and then vice versa, a subsidiary that becomes IFRS 9. That is 2. The other 2 is where a subsidiary increases its shareholding, so it becomes a bigger sub, or other way around, a subsidiary reduces its shareholding but still remains a subsidiary, so just basically becomes a smaller subsidiary. So those are the 4 types of change in ownerships that that a CTA level 1 student needs to know. CTA level 2, like I said, all of them. Okay, so basically IFRS 9 or normal sub to a after IFRS 9 a normal investment to a subsidiary, vice versa, meaning subsidiary to IFRS 9. You also need to know a sub to a sub, either a sub increasing its shareholding and still a sub, or a sub decreasing its shareholding and still remaining a sub. So that's the 4, which is exactly the same as CTA level 1. What are the other ones? There's various scenarios, right? So I'm just going to give you examples, but there are various scenarios, and that is why I'll teach you a way of thinking, so that no matter which scenario you get, because we can't cover every aspect, okay? There's no way we're going to cover every aspect. So I need to give you a thinking process. I need to give you a way of thinking so that you are able to handle any scenario. But an example would be a sub reducing its interest and becoming an associate, or an associate increasing its percentage, its interest, and becoming a sub, or associate reducing to a normal investment, or normal investment reducing to an associate. Okay, things like that. There are various aspects, so those are the typical ways of what you need to handle. Okay, so just take note of that. Now, the question you need to ask yourself, remember I said you need to always think about all the statements that are impacted: income statement, balance sheet, statement of changes in equity, cash flow statement, as well as the notes to the financial statements. Okay, so we will cover the notes to financial statements both now and when we deal with cash flows, but we're not going to deal with the cash flow implication now. We'll deal with the cash flow implication later on, okay? So how do you think? That is the important aspect. You need to always ask yourself, in the year that the change takes place, when did the change take place? Okay, so you need to identify when did the change take place. So the way I like to look at it is as follows. You draw up a timeline, okay? Beginning of financial year, end of financial year. So beginning of financial year and the end of the financial year. That is how you look at it. So on that timeline, you will need to ask yourself, when did the change take place? So that means on the timeline you would have before the change and after the change. So you must always ask yourself, for an income statement, the income statement looks at the entire period, okay? So let's say our financial year is 1 January until 31 December. Okay, so let's just say that's our financial year, 1 January to 31 December. Let's assume that on 1 October or 30th September, let's just go with 1 October, a change in ownership takes place, whichever the change in ownership is. Okay, so you draw a timeline, 1 January to 31 December. Somewhere in between, you draw another line that is 1 October 2019. On 1 October, ignore 2019, that just slipped. On 1 October, you have the change in ownership. Now let's assume that you had an IFRS 9 before the change in ownership, and as a result of the change in ownership, you now have a subsidiary. Okay, so there are three big events that you need to think about. Sorry, there's one big event with three implications. Okay, so one big event, which is a change in ownership, with three implications. The one implication is the date of change. What are the journal entries that need to take place at that date? Most of the marks will be around that date. But to help you to think through any scenario, we said before the change, we had a normal investment. After the change, we have a subsidiary. So that means from 1 January up until 1 October or 30th November, we have a normal investment, an IFRS 9 investment. So the accounting treatment in the income statement will be that of a normal IFRS 9 investment. From 1 October up until 31 December, we now have a subsidiary. That means for those 3 months, we need to do what? If you have a subsidiary, what you need to do? You need to consolidate. So now my income statement has two implications. For 9 months, it is normal investment. For 3 months, it is a subsidiary. So for 9 months, I do account for it as normal, but for 3 months, I need to apply consolidation. What does consolidation means? You bring 100% of the subsidiary onto your books on a line-by-line basis. But now you can't bring on 12 months. You're bringing on 100% for 3 months. Okay, so that's the implication. So for an income statement, you ask yourself, what did I have throughout the year? And the way you look at it, you draw a line where the change in ownership took place. Then you ask yourself, before the change in ownership, what did I have? After the change in ownership, what do I have? And depending on what is the nature of the investment, that will drive what is the accounting treatment, and you apply that accounting treatment in that time period. So like I said, a normal investment, IFRS 9, you apply IFRS 9. With a subsidiary, you have to consolidate. Okay, so keep that in mind. That is the thinking for an income statement. When you come to the balance sheet, income statement says what happened throughout the period. The balance sheet says, what do we have at this point in time? What is the point in time? The financial year end. So 31 December, what do I have? Remember, in the last 3 months, on 1 October, we had a change in ownership, which resulted in a subsidiary. Therefore, at 31 December, what do I have? I have a subsidiary. As a result, what do I have to do? I have to consolidate. So my income statement is consolidated, but only for 3 months. My balance sheet is completely consolidated because the balance sheet represents assets and liabilities at a point in time. Okay, very, very important. So if you can get that thinking right, no matter what you are given, you'll be able to handle it, provided now you know how to account for a subsidiary, you know how to account for a normal investment, you know how to account for an associate. But let's assume you know that, right? So let's assume you know how to consolidate, you know how to equity account, you know how to deal with IFRS 9 investments. So when you deal with change in ownership, all you do is draw a timeline, beginning of year, end of year. In between beginning and end of year, there will be a change in ownership. Draw the change in ownership line. So like I said, we have Beginning of the year, we have 1 Jan. The end of the year, we have 31 December. In between 1 Jan and 31 December, what do we have? 1 October. So now we have 3 lines, beginning in change in ownership. Before change in ownership, I have IFRS 9. So my accounting treatment is fair value in terms of IFRS 9. After change in ownership, I have a subsidiary. What's the accounting treatment? Consolidate. Therefore, for those 3 months, from 1 October to 31 December, I need to consolidate 100% of the subsidiary during that period on a line-by-line basis. I need to bring on. That is the income statement. The balance sheet at 31 December, which is at the point in time, which is the end of the financial year. What do I have? What is the nature of the investment? I have a subsidiary. So what is the accounting treatment? Consolidate. Therefore, my balance sheet will be 100% of the parent plus 100% of the subsidiary on a line-by-line basis. Please take note of that. Okay? Now just remember, so that is income statement, that is balance sheet. Now remember, 1 October is the big day, change in ownership. The question you need to ask yourself, what happens on that date? There's going to be lots of marks over there because there's a big thing that's happening. There's a change in ownership. In this example, we went from IFRS 9 to a subsidiary. So that means on 1 October, we're becoming a subsidiary for the very first time. When you become a subsidiary, when you gain control, which means you become a subsidiary for the very first time, what is that date called? That date is called the date of acquisition. So what happens on the date of acquisition? We recognize NCI for the first time, and more importantly, we recognize goodwill. So that's important to take note. When you go from IFRS 9 to subsidiary, you're becoming a subsidiary for the first time. So therefore, you need to recognize goodwill. So on 1 October will be the date of acquisition. And that's where you do your acquisition related journal entries. So just make sure you get that straight. Similarly, the other way could have taken place. Still, our year end, 1 January to 31 December. On 1 October, there's a change in ownership. What happened? On 1 October, you went from a subsidiary to a IFRS 9. Why? You lost control. So, from 1 Jan to 1 October, what is the impact on the income statement? From 1 Jan to 1 October, you were a subsidiary. So what do you have to do? You have to consolidate during that period. 100% of the parent, 100% of the subsidiary on a line-by-line basis, but only 100% for those 9 months. In the last 3 months, you don't have a subsidiary. You have an IFRS 9 investment. As a result, the income statement will only have those impacts, which generally is nothing. Okay? So that is the income statement. Then we look at the balance sheet. We look at 31 December. What do I have? At 31 December, the nature of the investment is an ordinary investment. So therefore, I do not consolidate, but rather I apply IFRS 9. So what do? We have a line item in the balance sheet called investment in whatever the company's name is. Or the typical name you need to use, investment in equity instruments. Okay, so just take note of that. So what is the thinking? The thinking is, what do I have in my income statement? But the income statement thinking is, what do I have before the change and what do I have after the change? And you will account for the income statement based on the nature of the investment before and after. For the balance sheet, it is all about what is the nature of the investment at the end of the year. And that is the critical thing. Whatever the nature is at the end of the year, that is how you account for the investment. Okay, so remember, we are still using our same accounting principles that we learned at the beginning of the year in terms of subsidiary, in terms of associates, and so forth. Okay. Now the big change, 1 October, 1 October, that date is the big event. What happened at that date? What happened at this date, 1 October? We lost control. Because we lost control, we no longer can consolidate. So what we're going to have to do, we have to get rid of goodwill. We have to get rid of NCI, because remember, we can no longer have goodwill, we can no longer have NCI, and we have to get rid of the assets and liabilities of the subsidiary. Okay, so just take note of that. That's very, very important. So that is that is the thinking that needs to take place. Okay. So now I'm going to look at the scenario, because I chose an IFRS 9 to a, I think I chose an IFRS 9 to a, let me just check again. I think I chose an IFRS 9 to a sub. The next lesson will be sub to sub. Let me just check now. Just give me a moment. Yeah, so I chose IFRS 9 to a sub. In the next one, I would cover sub to sub. Okay, so now I'm going to share my screen, and I'm going to read. We're only going to do part 1, and we're only going to focus on the increase in shareholding. Okay, we're not going to do the entire question. I just want to focus on the increase in shareholding. Okay, and then I'll stop it. I am doing some more videos for you, so we can do more scenarios, but I won't be able to cover every scenario live in a class, but I am doing some recordings so we can see how to deal with the various options, and mainly how it impacts the income statement, how it impacts the balance sheet, how it impacts the statement of changes in equity. So you need to know about 4 things, okay? The impact on the income statement, meaning you need to prepare an income statement. The impact on a balance sheet, meaning you need to prepare a balance sheet. You need to be able to do journal entries for any of them. And as a result of those 3, you need to be able to do number 4, and that is be able to calculate them. Okay, so sometimes they will just ask you for a calculation, but no matter which scenario you're busy with, whether it's income statement, balance sheet, or journals, you will still have to be able to calculate them. Okay, so we will focus on those. And then when we do cash flows, I'll show you the impact on the cash flow statement when we get there. Okay, so I'm going to share my screen, and I'm going to read the scenario. We'll read the entire part 1, but I'm only going to focus on the change in ownership. Okay, so part 1, ice cold. For the CTA2 guys, remember you need to also attempt associate 1. So I'll focus on the 4, but I'm going to do 1 with associates as well, so you can see. Because it's just the thinking that you need to get right. But I know it's maybe the calculations as well. But once you have the thinking sorted, then if you can't get the calculation, you know just that aspect that you need to deal with. But make sure you know what needs to be done, then we can deal with the how. Okay, so Ice Cold is a JSE listed manufacturer company that specializes in the installation and maintenance of ice rings nationally. They self-manufacture all the components for the installation of the ice rings. The company was founded in 2006 and have become the preferred installer of ice rings nationwide. ICE acquired the following investment at its market value. So I don't know how to pronounce that. Pavel, whatever, holding. There's a 15% holding. Data acquired 1 September 2020, market value 160,000 Rand. What's important, you are 9 CTA. Remember, a percentage does not necessarily mean that you don't or do have control. But in the absence of any information, contrary to normal, then you assume that whatever percentage you have dictates your nature of your investment. So remember, the general rule is if you have 20%, if you have more than 20%, or at least if you have at least 20%, but less than 50%, then you have an associate. If you have more than 50%, then you have a subsidiary. And if you have less than 20%, then you have a normal investment. Okay, so that is the general rule. But remember, if you read the accounting standards, that you can have 1% and have control. So just take note that if they don't give you information contrary to that, you can use your percentages as a guide. Okay, so I'm assuming they're not going to test control and all of those type of things. So the fact that we have 15% means we have an ordinary investment, meaning we have an IFRS 9 investment. Now there's an increase in shareholding, and this is what we're going to focus on, okay? At a strategic shareholders meeting, the shareholders decided to increase their shareholding in Pavel to 75%. So that means it increased by 60%. As it made sense to invest in a company that deals with all the ice rink seating arrangements. On 31 July 2016, ICE paid a cash consideration of 760 for the additional shares, which was deemed to be the fair value at that date. From that date, ICE had control over PAV as per the definition of control in accordance with IFRS 10 consolidated financial statements. Okay, so now let's understand. Our financial year, where's our financial year now? They give us a financial year. Okay, we don't know when is the financial year. Let me just see. Okay, so it looks like 31 March is a financial year. Somewhere here, oh, there they say. Here they say, all companies in the ICE group have a 31 March year end. So all companies in the ICE group have a 31 March year end. So they acquired, this on 1 July, 31, where am I reading now? They acquired this on 31 July 2016. So that means the end of the year is 31 March 2017. The beginning of the year is 1 April 2016. So our financial year, 1 April 2016 to 31 March 2017. Beginning 1 April 2016, end 31 July, 31 March 2017. That's our financial year. On 31 July 2016, somewhere in between, a big event took place, a change in ownership took place. Now, if we just say, we have April, May, June, July. Okay, so that's 4 months. So that means 4 months, we had a 15% interest in the 2017 financial year. And for 8 months, we have a controlling interest, okay, a 75% interest. So on 31 July, that is the big day. You make a mark over there, change in ownership. Before change in ownership, from 1 April 2016 up until 31 July 2016, we had a normal investment. So therefore, the accounting treatment is, in the income statement, would be IFRS 9. From 31 July 2016, or let's say 1 August, up until 31 March 2017, those 8 months, we have control, and therefore for that 8 months in the income statement, we will have to consolidate. What does consolidate means? We must bring on the subsidiary's income and expenses on a line-by-line basis at 100%, but not 100% for 12 months, 100% for 8 months, and not any 8 months, the 8 months from 31 July or 1 August up until 31 March. Okay, so just keep that in mind. That is the impact on the income statement. 4 months ordinary, 8 months having control, therefore consolidate. That's the income statement. Now we look at the balance sheet. The balance sheet is at a point in time. So at 31 March 2017, what do we have? At 31 March 2017, we have a subsidiary. That means we have to consolidate. That implies we must bring on assets and liabilities on a line-by-line basis at 100%. Okay, so just keep that in mind. Now, what was the big day? The big day was 31 July 2016. There's obviously going to be an impact of journal entries. There's going to be journal entries that happens on 31 July 2016. What are those journal entries? It is all depending on, it all depends on what was the change in ownership. So the change in ownership that took place on 31 July 2016 was a normal investment becoming a subsidiary. That means for the very first time, we are a subsidiary because for the very first time, we gained control. So that means on 31 July 2016, the simple journal entries are the at acquisition date journal entries. The exact journal entries that we have done at the beginning of the year when we did subs is going to happen over here with one slight adjustment. And I'll tell you about it just now when we read about it now. So on 31 July, what is the big journal, or what's the big event? Change in ownership. The change in ownership was normal to sub, so therefore we gained control. So what do? We process the at acquisition journal entries, very similar to how we processed at the beginning of the year, only there will be just one slight difference, significant but subtle. Okay, we'll talk about it now. So they say all assets and liabilities are considered to be fairly valued except for land. Land with a cost price of 500,000 had a fair value of 560 on 31 July. No additional assets and liabilities were identified at the acquisition date. Okay, remember, we're going to have to do a fair value adjustment similar to how we did above. So what is this one aspect? Remember, I don't know if you recall, but I told you that I gave you a format for goodwill, how to calculate goodwill. We said consideration plus NCI minus fair value of net identified assets gets you goodwill. But each time we did it, or almost every time we did that calculation, I told you that this is slightly going to change when we come to change in ownership. So now we finally come to change in ownership. So now it's going to change just slightly, just a small adjustment. I didn't want to bring it in then. I didn't want to confuse you then. So now we'll bring it because now it will make sense. This is a rule or a principle, if you would like to call it that the accounting standard says. When there is a change in ownership and the change in ownership results in the change of the nature of the investment. So when there is a change in ownership and the change in ownership results in the change of the nature of the investment, remember, or a change in the type of the investment. Remember, type or nature is, here we went from ordinary to subsidiary. Okay, so we went from a normal investment to a subsidiary. That is a change in the nature of the investment, because it's not normal to normal. It is not sub to sub. It is normal to sub or sub to normal, whichever one. But whenever you have a whenever there's a change in ownership, and the change in ownership results in a change in the nature of the investment, like in this case, went from 15% normal IFRS 9 to 75% subsidiary, that is a change in the nature of the investment. Then you are deemed to have sold your entire stake and reacquired it. So what is happening? What happened in the real world? In the real world, I have 15%, and then I acquired a further 60%, and that gives me 75%. Okay. Now IFRS 10, I think IFRS 10 says when there's a change in ownership that results in a change in the nature of the investment. Here we have a change in ownership, and the change in ownership results in the change of the nature of the investment or the type of the investment. It went from normal investment to subsidiary. That is a change in the nature, or that is a change in the type of the investment. Then accounting is saying, because of that, we know in the real world you only acquired a further 60%, but accounting is saying we deem it is we are telling you that you are deemed to have sold the 15%. So that 15% is deemed to have been sold at fair value. So let's say like here we acquired it on 1 September 2010 for 160. Okay, so we acquired it on 1 September for 160. Okay, let's assume that on 31 July 2016, the fair value is 200,000 for that 15%. So accounting is saying you are deemed to have sold that 15% at fair value. You didn't really, okay, but you are deemed to have sold it. So the journal entry from accounting is saying credit investment in Payville, credit investment in Pave. What must you credit it at? You must credit it at fair value. So you are deemed to have disposed of it. What did I just say now? We have an investment. Yeah. So we credit the investment, and so what you first do. So we say that investment is the fair value is 200. So you first do a fair value adjustment. You're going to say debit Pave at 160 at 40,000. So now the Pave is at the Pave is now sitting at 160. Then you are deemed to have disposed of it. So you're going to credit it at 200,000. So you have to account for that fair value adjustment. That's very, very important. So you're deemed to have disposed of it at fair value, and then immediately you are deemed to have bought it back at fair value. So all accounting is saying you sold the 15%, and then you have deemed to bought it back. So what are we doing? You're basically acquiring a new 75%. So just take note of that. I'll show you how to do the calculation. But what is the critical part is that you have disposed of it at fair value. So if our cost price is 160 and fair value is 200, in your income statement, you'll have to recognize a fair value gain of 40,000 Rand. So just take note of that. Okay. I'm going to stop there because I want to just quickly deal with this increase in shareholding. This whole question has more. Here you can see here is some more changes happening. But we're not going to deal with that now. I just want to deal with this aspect of PAV, okay, the increase in the shareholding. What would have happened on 31 July 2016? So I'm gonna quickly open up Google, so to get Google spreadsheet, and then we will work through it. While I open up, do you have any questions? Any questions while I'm opening? I'm just taking some time here. Okay. Okay. This FAC4862 Test 320, what was it, 2017. Okay. So I just want to show you what would have happened. So if I draw a timeline here for you. Okay, so if I just draw a timeline over here. Okay, so if I draw a timeline over there. So here we have 1 April 2016. Here we have, what was it? 31 March 2017. Okay, 1 March 2017. That is the beginning of the year and the end of the year. Okay, so what 31 March, 31 March and 1 April, one is the beginning, one is the end. Okay. So this year is beginning of year. This year is end of the year. Then somewhere down the line, which was, what happened here? So beginning of year, end of year, what happened on this date? 31 July 16. What happened? We have change in ownership. Okay, so this year is change in ownership. Change in how to spell ownership. Okay, so change in ownership. So from the beginning of the year up until the end of the year, so here we have, 4 months of normal investment. So therefore apply IFRS 9. Over here, okay, 8 months of control. Therefore, what do we do? Apply consolidation. Consolidation. So what you must know, in the income statement looks for the entire period. So part of the period, normal investment, part of the period, consolidation. As a result, part of the period control, therefore consolidate. So for 4 months, I apply, there's no consolidation, normal accounting treatment. For 8 months, I have to consolidate, pay PAV, and as a result, I must bring on 100% of PAV's assets, PAV's income and expenses on a line-by-line basis, 100%, but only the income and expenses that was during this period, not the entire year, only for these 8 months, okay? Very important. Now, so that is for the income statement. For the balance sheet, I come over here and I say, at 31 March 2017, what do I have? At 31 March 2017, I have control, which means I have a sub, which means I need to consolidate. Okay, so therefore on the balance sheet side, I'll bring on 100% of the assets and liabilities on a line-by-line basis. 100% of the assets and liabilities on a line-by-line basis. Okay, so just take note of that. That's how you think through it. What do I have in my income statement? Before and after change in ownership. What do I have on my balance sheet? At the end of the financial year. What do I have for my balance sheet? It depends on the nature of the investment. The next big thing is the transactions that need to be recorded at the date of change in ownership, at 31 July. So on 31 July 16, there was a change in ownership. Okay. Which resulted in an ordinary investment becoming a subsidiary. Okay, which resulted in an ordinary investment becoming a subsidiary. This is your thinking you're going through, right? Obviously not as long as I'm taking. This is happening subconsciously in your mind, okay? So which resulted in an ordinary investment becoming a subsidiary. Okay, that means for the very first time, at this date, we gained control. Okay, so that means this date, therefore, this date is the date of acquisition. So what happens at the date of acquisition? We must eliminate ordinary equity. We must eliminate all equity. We must recognize, so we must eliminate all equity. We must eliminate the investment in the subsidiary. We must eliminate the investment, in the subsidiary. We must, what must we do? We must recognize goodwill, we must recognize NCI, and we must recognize any fair value adjustments, okay? But because it's a change in ownership scenario, and this change in ownership resulted in a change in the nature of the investment, there's one added spin. And that spin is the original investment is deemed to have been disposed at fair value and then reacquired at fair value. So when you work out goodwill, you have to work it out as follows. Remember, the normal goodwill calculation was as follows. When we calculated goodwill, what did we do? We said consideration. Okay. Then we said, what did we say? Plus NCI less fair value of net identifiable assets, and that gave us goodwill. So this gave us goodwill. So here we have goodwill. Okay, so there we have goodwill. That's how we usually did it. Now we're adding another spin to it. So what you must know, this consideration, you must call it the additional interest. Okay, this is the additional interest. What was the additional interest? The 60% that we acquired in the current year. Then it must be plus also consideration, but it's also form part of consideration, but it's a deemed consideration, which is the fair value of the original interest. So remember, I said that accounting standard says you are deemed to have so we started from over. The accounting standard says that when there's a change in ownership, that results in the change of the nature of the investment, that results in the change of the nature of the investment. So in this scenario, was there a change in ownership? Yes. Question 2, did this change in ownership result in the change of the nature of the investment? And the answer is yes. What do we mean by change in nature? Before and after, was it still a subsidiary? No. Before and after, was it still a normal investment? No. Before it was a normal, after it was a subsidiary. So therefore, before and after, the nature of the investment is not the same. The nature of the investment is different. So that means this change in ownership resulted in a change in the nature of the investment. As a result of that, the accounting standard says when you have a change in ownership that results in the change in the nature of the investment, then what? Then you are deemed to have disposed of your original interest at fair value. What was our original interest? The 15%. So we are deemed to have disposed of that 15% at fair value. So that means when we make that sale, when we make that deemed disposal, we will have to recognize a fair value gain or loss. So in my example, like this question had 160, and I'm assuming we'll get to the right fair value number now. Let's assume the fair value was 200. So that means we'd have a fair value gain of 40,000 Rand. So that is important. So you are deemed to have disposed of it at fair value. And then immediately you are deemed to have reacquired it at fair value. So the reacquired fair value would be put in over here, plus consideration, which is the fair value of the original interest. So you are deemed to have disposed the original interest and then reacquired it both at fair value. So therefore, we might just take note of that. Okay, so let's have a look how we would deal with this goodwill calculation. So what would happen? The additional consideration is what the actual consideration on 31 July was. So the actual consideration on 31 July was 760,000. It is a pure cash consideration. Okay. Remember, the rules of consideration, as we covered in the beginning of the year, still apply. But generally, they keep it simple over here. Okay, they'll generally be a bit more challenging in a non-change in ownership. But just take note, doesn't mean it can't be challenging. Okay. So just take note, the additional interest was the 60%, 760. Now we need to also add the consideration, the fair value of the original interest. So remember, we have deemed to have disposed of the original interest at fair value and then reacquired it. So let's see how we can calculate it. If you read this very carefully, if you read the scenario, let me just quickly switch back to the scenario. If you read the scenario very carefully, you should be able to see the scenario. Just tell me if you don't. On 31 July 2016, ICE paid a cash consideration of 760 for the additional shares. How much does this additional shares represent? 60%. That is the additional shares, which was deemed to be the fair value at that date. So we need to use this 760 to get the fair value of that 15%. So the way we'll do it is as follows. You should see Google Sheets now again. Okay, so the way we will get it is as follows. Remember, we need the fair value of the 15%. They never gave us the fair value of the 15%. In some cases, they will give it to us. In some cases, they will give us the fair value of each share. And in that way, you can work out the fair value of the 15% interest. But in this case, they never gave us the fair value of the 15% interest, nor did they give us the fair value of each share. Okay, well, I never read the entire scenario. Maybe they did. So another way to calculate it is they told you that this 760 is fair value, but fair value representing the additional interest, which is 60%. So we can work out, we can say, we know that 760, it is 760 divided by 60. So we say 760 divided by 60, it is going to give you the fair value for every 1%. And then if we multiply that by the 15, we will get the fair value of the 15%. Okay, so to put it a better way, you'd have said 15 divided by 60 multiplied by 760. I'm just showing you that the way to think of it intuitively, 760 represents the fair value of a 60% interest. So if you divide it by 60, that means you will get the fair value for every 1%. So now that you have the fair value of every 1%, if you multiply by 15, you will get the fair value of 15%. So in a better mathematical way written, we'll say 15 divided by 60 times 760. So therefore, the fair value of the consideration, the fair value of the original interest is equal to 760, 123 times 15 divided by 60. So the fair value is 190. So the total consideration. So if a question asks you, what is the consideration? The consideration is not 760. The consideration is, how much is that? Where do we see this? The consideration is 950,000 Rand. Very, very important. The consideration is not 760. The consideration is 950. The actual consideration of the additional interest plus the deemed consideration because remember, accounting is saying you are deemed to have disposed of the original interest at fair value and then reacquired it at fair value. So therefore your consideration is the actual consideration plus the deemed consideration. Please be aware of that. So if they ask you what is the consideration, it is not 760, it is 950. Just to show you, remember there will be a gain or loss on this thing. So remember proceeds, when you sell something, we say proceeds less carrying amount, which will give us gain or loss. The proceeds of this deemed disposal is the fair value. The proceeds of this deemed disposal is the fair value. We have worked out the fair value to be 190. So we've worked out the fair value to be 190. The carrying amount was how much? 160. So the gain or loss. So this is not the gain or loss on disposal. This is not the gain or loss on disposal. This is the fair value gain, okay, of 30. I don't know why I'm typing it. Okay, so just be aware of that, because the real journal entry look as follows. Investment in PAV, 30,000. Credit fair value gain, P&L, 30,000. So just be aware of that. It is not a gain on disposal. It is a fair value gain. Okay, very, very important. So now we can do the journal entries. So now we can do the journal entries. So the journal entries on 31, remember, this is only happening from a consolidation point of view. Okay, you're only doing this from a consolidation point of view. Remember, all consolidation journal entries take place at the end of the current financial year. All consolidation journal entries take place at the end of the current financial year. But just to give you perspective, the journal entries that you do at the end of the current financial year relating to 31 July 2016 would be your at acquisition journal entries. Now, I don't know what is, do they give us income statements? Okay, yeah, they're giving it us. Okay, so on 31 July, you have to say financial information. An extract of the financial information of PAV was as follows on the respective dates. So here you can see on 31 July 2016, we have ordinary equity, we have retained income, and we have mark-to-market reserve. We have financial assets, and then we have property, plant, and equipment. Okay, so they're giving us that. Mark-to-market reserve relates to fair value gains on the financial assets. Okay, so that's fine. But what was the equity at the date? So let's have a look. So therefore, what would we be doing? Remember your journal entries. We would have share capital. This SCE, or you can call it SFP, doesn't matter. But generally, statement of change in equity accounts, we call SCE, assets and liabilities, SFP. Income and expenses that goes through the profit or loss, we call P&L. Income and expenses, gains and losses that goes through OCI, we say OCI. Okay, then we have retained income. Then we have, what was the other thing? Retained income. Then we have marked to market reserve. What was the next thing? That was the three. Okay, so this is all SCE. Journal entry, 200. 850, 400. What was the other one now? 209, 500. So remember, journal entry number 1, eliminate share capital. So there we're eliminating share capital. Journal entry number 2, eliminate the investment in subsidiary. Okay, so remember, the investment in subsidiary is going to be the total number. Okay, so it must be the total number. So the investment in subsidiary must be the total number, which is the 950. Okay, so investment in sub, the investment in subsidiary is the total number, the additional consideration plus the fair value of the original interest, SFP. So remember we, SFP, remember we're eliminating equity. Equity is a credit balance. To get rid of equity, we debit. Similarly, investment in subsidiary is an asset, which is a debit balance. To get rid of the asset, we must credit it. $950. So number one, we eliminated equity. Number two, we eliminated investment in subsidiary. Number three, we recognize fair value adjustments. What was a fair value adjustment? It went against land, and land is asset, so it's SFP. It went from 500 to 560, I think. It went from 500 to 560. So from 500 to 560, which is 60,000 Rand. It's a fair value adjustment. It increased by 60,000. What comes with that? We will have deferred tax. So remember, deferred tax, SFP, this will be a liability. What is that? It'll be, because it's land, so it'll be 80% times 28%. So it is the gain multiplied by 80% multiplied by 28%. So remember, it's a capital asset, so it's at the CGT rate. The next would be what? Where's this now? Okay. The next, we're going to have to recognize NCI. So the next, we have to recognize NCI. Because remember, NCI NCI is only as a result of consolidation. So you have to recognize non-controlling interest. Non-controlling interest is equity. So we'll say SCE. Non-controlling NCI is equity. We're recognizing it for the first time. So therefore, equity is increasing. Equity increases on the credit side. So we have to work out the credit. So remember, NCI can be recognized, can be measured at the date of acquisition in one of two ways, either at fair value or at their proportionate share. We need to read what it is. Okay, and then finally, we will either recognize goodwill or a bargain purchase gain. So most likely goodwill. So let's quickly go have a look what it is. So for NCI, that's generally the additional information. NCI is measured at its proportionate share of the acquired. Okay, so its proportionate share. So now we can work out the fair value of the net identifiable assets. So remember, the fair value of the net identifiable assets is as follows. So it'll be as follows. If I just do the workings here quickly. So fair value of net identifiable assets calc. We add up all equity, which is share capital, which is retained income. Okay, let me just copy it. So at the date of acquisition, these are all the equities at these amounts. Then we do any fair value adjustments, which we know was land and deferred tax. So land and deferred tax. So remember, land was 60,000. Deferred tax is in a reducer, so it's equal to the negative of 60 times 80% times what? Times 28%. So therefore, the fair value of the net identifiable assets would be the sum of all of those. Okay, fair, yeah. Okay. So what's the sum? 1306. So what's important over here is the following. If we put in, that is the fair value of net identifiable assets, NCI is their percentage, so it's going to equal the proportion of the net identifiable assets. They have 25%. So this will either give us goodwill or a bargain purchase. %. So it looks like we have a bargain purchase. Quite strange, but okay. So that means we have a bargain purchase. Just tell me if I did something, if the numbers are not right. Bargain purchase. A bargain purchase will go through P&L. Okay, so that is an important aspect. Now, what's important to take note that what's important to take note is the following. In the books of the parent, they may not have done the deemed disposal. Okay, so in the books of the parent, they may not have done the deemed disposal. They would have just acquired the additional interest. Okay, but remember, from a consolidation point of view, you are deemed to have disposed of it. So in the parents' books, they would just have 160 plus they would just have 160 plus the 760. So from a group perspective, the group would have done the following journal entry. The group would have done the following journal entry. They would have said, because in the books of the parent, in the books of ICE, the separate books of ICE, they would just have whatever they have, 160 plus that 760, because they are not required to still do this adjustment. This adjustment is only required from a group perspective. So did the parent actually dispose of the 15%? The answer is no, they didn't. So all they did when they did their journal entries, when they acquired the investment, they said credit bank 760, debit investment in PAV 760. So in the groups, in the parents' separate books, they would have 760, the additional interest, plus 160, the original interest. So they would have 160 plus 760, which is 920. But you know, from a group perspective, the group says that we have actually disposed of the asset and then reacquired it. And the way we disposed of it was a deemed disposal at fair value and then reacquired it at fair value. So basically the journal entry that they would put through is as follows. They would say, we're just going to increase our investment. We have to dispose of fair value. So we're going to say fair value is 190. The current amount is 160. So therefore, the investment in PAV must increase by 30,000. So their journal entry will also be investment in PAV, increase an investment. To increase an investment, you're increasing an asset, and asset increases on the debit side. So 30,000. For every credit, there must be a debit. This is a deemed disposal. So we are deeming a disposal. And how do we dispose of it? At fair value. So we must first recognize fair value. So we say fair value, it's a gain because we are increasing P and L 30,000. There is no need to actually do the disposal investment, the disposal journal entry, because if you want to dispose of the journal entry, just on the side, it will look like this. Just on the side, it will look like this. If I say debit, credit, you want to credit the investment. So you're deemed to have disposed of it. So what you'd have do, you'd have done this. Credit investment in PAV. Credit the investment in PAV. What is the investment when you dispose of it? You disposing of it at fair value, which is 190. Okay. And then immediately you are reacquiring it at fair value. So then you're going to say, so immediately are you reacquiring it at fair value? So you're going to say 190. So therefore, there's no need to do the journal entry because the credit and debit to the same account. But then what is the point of the disposal? What is the point of the deemed disposal? The point of the deemed disposal have two implications. Number one, you're recognizing a fair value gain or loss, in this case, a fair value gain. And number two, because now the total consideration is now different, it has an impact on your goodwill or bargain purchase. Okay, so just take note of that. It has an impact on your goodwill or bargain purchase. Okay, so just take note of that. So when is there a deemed disposal? Only if there's a change in ownership and the change in ownership resulted in a change in the nature of an investment. So if, for example, another example would be a subsidiary, a company has a controlling interest of 60% and increased their shareholding to 80%. Before the change in ownership, they were a subsidiary. After the change in ownership, they are still a subsidiary. So there is a change in ownership, but the change in ownership did not result in the change of the nature of the investment. As a result, there won't be a deemed disposal. In this case, there is a deemed disposal because before you are a normal, after you are a sub, as a result, there's a change in the nature of the investment, and therefore you are deemed to have disposed of the original investment at fair value, and then immediately reacquiring it at fair value. Okay, so just take note of that. Therefore, the gain or loss, this gain or loss can't be a gain on disposal, nor if it was a loss, it can't be a loss on disposal. It needs to be a fair value adjustment. Okay, so just take note of that. So, well, I think there's not even, depending on, I do it to P&L, I may be wrong, eh? It depends how the company accounts for it. If the group accounts for fair value adjustments relating to financial assets through OCI, then we must take this through OCI. Okay, so just be aware of that. But basically, what's important, we have to bring through the journal entry because most likely the parent did not. Okay, so that in a nutshell is the main impact. So this is the easy one. Okay, this is the easy one out of the four. The other two is the next easiest. I think the most challenging one, which is not challenging at all, but the most challenging one out of the four is when you are a subsidiary and you're becoming a normal investment. Then it's a little bit challenging because you have to get rid of goodwill. You have to get rid of NCI, and because the parent actually disposed of something, they may have recognized a gain or loss. But that gain or loss will be very different from the gain or loss from a group perspective. So we'll have to get the correct group profit or loss amount as a result of the disposal. So that's the most challenging one, but it's not even that difficult. So I'll stop here for tonight. In the next one, I'm doing a few videos for you. One on shareholding increase, sub to sub, increase and decrease, and then also the other one. But as we go through FAC2, next week we'll cover another example, okay, on change in ownerships. Is there any questions that you guys have? If not, then we can call it a night. So just important, what to take note is this aspect over here, that when you acquire a sub for the first time in a piecemeal transaction where you have a change in ownership, then the consideration includes the fair value of the original interest. And when you do the initial journal entries, the at acquisition journal entries, you need to bring through this fair value adjustment. It could be a fair value loss. In this case, it happens to be a fair value gain. What's the thinking behind it? When there's a change in ownership that results in a change in the nature of the investment, what do you have to do? You are deemed to have disposed of your original interest at fair value and then immediately reacquired it at fair value. So the fair value adjustment happens to be 30,000. Okay. Any questions? Bernice, Faid, Fakir.
No questions.
Okay.
No questions.
Rebecca, Ryan. Okay. Ryan.
No questions.
Okay. We're going to do some more. I'm doing some more recordings, and I'll send it to you by the, should be by the weekend, on the different change in ownerships. I'll send you my. I'll just on the Google Drive, I'll just add my raw notes on change in ownership. I'm just polishing it up, but in the meantime, you can get the raw notes and you can read through it. I'm just polishing it up a bit so it can be a little bit more robust. But I'll share it tomorrow. Okay. Other than that, I'll see you guys next week. Actually, not next week. This weekend, we'll have a 1-hour session just to complete yesterday's lesson. So those who are doing FAC1, FAC3, we have 1 hour left because of load shedding yesterday. So we're trying to complete that question. Remember, I'll actually share the the lesson, the video now this evening. Try to do that carrying amount in the meantime. Even if you don't try to attempt it, not required to attempt it, but it'll be in your best interest if you do attempt it. But I'm still going to do it and then complete the actual impairment calculation. Okay, guys, I'll see you then on Saturday. I'll confirm by tomorrow, Friday, the time, but it'll be late morning, and then we will complete it. Okay, see you. Bye-bye.